The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. This is Andrew Wilkinson, Director of Trading with Interactive Brokers. Welcome to today's event, hosted by Interactive Brokers, but with our wonderful presenter, Russell Rhodes, CFA, who is with EQDerivatives. And with that, I'm going to hand over, before a couple of items of housekeeping. So there are handouts to today's session available in the GoToWebinar panel for you. If you have questions for Russell throughout the session, please enter them into the question bank, but only once. Russell will get to your questions, and if he doesn't, I'm going to make him answer them at the end of the session. And with that said, I'm going to hand over to Russell. Tell me a little bit about your role at EQDerivatives, Russell, where you're head of research and consulting.
Sure. So I joined EQDerivatives back in March, and basically I do research on product usage in mostly the equity derivatives and volatility space. So on the EQDerivatives website, there will be articles which are in front of the paywall that I've written about trading strategies that you can implement using VIX, VStocks, NDX. I've got a couple of things in the pipeline right now about potential small cap outperformance that's coming here. So I'll have some Russell 2000 things up shortly. But I always tweet out when I've put new things up. So that's probably, for the audience, that's probably what they would be most interested in that I'm doing over at EQD.
Very good. Very good. Russell is today going to talk to us about what happened in 2020 and what to look forward to in 2021 as regards the world of volatility. So, Russell, I'm going to mute my microphone. I'm going to keep an eye on the question bank, and over to you.
Okay. And as Andrew mentioned, I'll feel free to put a question in the question box if you've got something to ask. If it kind of relates to what I'm talking about at the time, I might address it. If not, I will definitely get to all the questions at the end. I promise. I pride myself on being able to do that. As always, I'm here for educational purposes only. And in anything that I talk about today, I'm not really often. I talk about trading strategies, not really talking about any specific trading strategies. Just a general look forward in 2021. Some interesting things that I picked up reviewing what went on in the equity volatility space in 2020. Needless to say, it was a pretty interesting year. I've got to talk about these four markets specifically: VIX, VolQ, RVX, and VStocks. If you have been on a webcast before where I've talked about VolQ, do know that Interactive Brokers now has the VolQ quote on their platform. I know there was when I first started talking about VolQ, which is slightly different than VIX, and has some things about it that I actually like a little bit better than VIX. Some people would be shocked to hear me say that, but it actually is something that you can find on the platform now. RVX is the Russell 2000, and VStocks, I like to refer to VStocks as the European Volatility Index, because it pretty much is a VIX calculation that uses options trading on the Eurostoxx 50. And then a few things to keep an eye out for in in 2021. Got a question? What's the name of it? I bet you're asking what the name of VolQ is. It's the NASDAQ 100 Volatility Index, and I'm certain I didn't say that when I was talking about it, but that's what VolQ does. So basically, if you look at these bullet points, it's S&P 500, NASDAQ 100, Russell 2000, and Eurostoxx 50, the associated volatility indexes. So this is the way that I actually like to, at a very high level, look at what any volatility index has been doing lately or over a certain period of time. I think the last price is not how you look at volatility indexes. You actually want to look at the average over a period of time. And believe it or not, this is one of those fun statistics. Believe it or not, the average for VIX in 2020 was the third highest on record, not I think if I'd asked anybody to rank it, they may have tried maybe number 2, possibly number 1. But 2008, 2009, we actually had a higher average. However, 2020 is going to stand out as the widest range because as we went into 2020, we were at we had been in a low volatility regime for a pretty long period of time, and we actually were looking at tweens, lower than the teens for VIX as we were entering the year. That changed very, very quickly, and hit the wrong way. And the other, the other volatility index that I really like to pay attention to is VVIX, which is basically a VIX calculation using VIX options. And that has remained above 100 every day since March, except for one day. And that 100 is a big over-under line. Now, we only have VVIX going back to 2007, but unlike VIX, VVIX actually remained elevated throughout 2020 when you compare it to previous years that had volatility events. And of course, that 2008-2009 time period is a period that everybody, I know there are different circumstances, but quantitatively, it's the closest comparison that we have. One thing I do want you to look at with respect to VVIX that in 2020, note that it was already relatively elevated going into 2020 as opposed to VIX, which is based on S&P 500 option prices. For VVIX, typically a higher level is being driven by purchases of call options. And the pandemic situation was starting to emerge in December. And I do think that there were entities taking long volatility positions just in case something that we ended up having a major economic impact with respect to the pandemic. Now, something that I really every time I do an Interactive Brokers webcast, I want to bring something that I really think is cool. I put a lot of pressure on myself, and Andrew will know that means sometimes I'm submitting it late because I'm trying so hard to find something cool. And this is actually the aspect of what I found interesting this past year. Now, this is a calculation using the combined long and short VIX futures positions and dividing it into the short VIX futures positions as reported by speculators to the CFTC once a week. This is the commitment of traders report. And on average, speculators are in normal environments. Speculators will be short VIX futures. It's just the most common way to trade VIX futures for professionals is having some sort of short volatility position. Now, what we have seen when we've had volatility events in the past, and we don't have really good COT data for the 2008-2009 time period. There were a couple of breaks in the data because of some volume issues. But we do have 2018 when we had the Volmageddon situation. And the real point here is where we've got that net long. And when the number goes negative, that means that there are more long positions than short positions. And every time we've had a volatility event, that has been a follow-up. We've had a few weeks where the speculators get out of the way. Well, we can't say that always happens now because in 2020, we never saw speculative money go net long VIX futures. Often we end up net long because the shorts some of the shorts will get blown out. They'll wait until they feel like we're in an environment that favors being short volatility. But lo and behold, in 2020, we did see a drop in net short positions, but we didn't go from basically the fast money, the hedge fund type investors did not go from being short to long. And this is the first time that we've had a volatility event that I have COT data available for that we didn't see hedge funds get out of the way for a while. And this has led to a few questions. And I'm going to go out with a survey on this one and see what people think, because I can give you a couple of reasons that I think this may have happened. And basically, the speculative money did not abandon short VIX strategies. Now, is this a function of traders getting smarter, realizing that when we do have the volatility spike, it's probably a better time to maybe add money to a short VIX position, even though you're having a major drawdown? Now, one of the managers that I speak to in my capacity at EQDerivatives said that they actually saw inflows in March because, and this is how he put it, because they had trained their clients. I like to say they had educated their clients to know that there was going to be some drawdown at some point in a short volatility strategy, but that's also not the time to panic. And then the other thing that popped in my mind is we don't really have a good short exchange traded product right now, just because of the fallout from 2018. We've got a short volatility ETP, but it's actually only half the position of a full short position. However, that might change in the near future. So somebody's asking me the Bloomberg index code for the CFTC VIX I was showing. I don't get the numbers from Bloomberg. I actually get them directly from the CFTC website. And John, if you want to send me an email, and my email address will come up at the end of the presentation, I'll show you exactly what data I'm working with, because I know there's a lot of CFTC data there. And this number to create this chart right here, there's actually a calculation involved in it as well. But if you shoot me an email, and I'll give you a little bit more of an explanation behind that. And it's public data. I'm happy to share the data with you as well. So, thinking about with respect to the performance that was associated with short volatility, SIBO teamed up with Eureka Hedge a few years ago to come up with 4 hedge fund indexes that follow certain types of volatility-related strategies. And they start on actually they're indexed to 100 on the last day of 2004. And this is the performance of short volatility hedge funds going through, basically running through the end of 2020. And what you can see here is this is exactly what you would expect for a P&L line associated with a short volatility strategy. You're going to have some drawdowns. It doesn't show up as well, but we do have that short index going from 200 to about 150. That's a nice 25% drop. And then we've got another drop in 2011, and we've got a final drop, that recently happened. And I found 3 instances where we had more than a 10% drop in the short volatility hedge fund index. And what I did was, you can sort of see it. I went back and I looked at how long did it take the short funds to recover, because on the far right here, the far right here, you can see we rebounded very quickly. So I wanted to see if the short volatility hedge funds were if they're learning a little more and they're rebounding more quickly. And we had these 3 10% plus drops occur in September 2008, August 2011, and February 2020. And it took the performance 22 months to recover from the first one, 17 months from the second one. And we actually saw the short volatility hedge funds recover in only 7 months this last time around, which I think is an indication. We've seen it in a few different data points. I've seen it from talking to investors as well, that you're more willing to step up after what I like to refer to as a volatility event. And here's the 2020 performance. And what's really interesting to me on this one, it's kind of an add-on here towards the end, but they have 4 categories. They got tail hedge, long volatility, relative value, and short volatility. And I indexed all of them to 100 as of the last day of 2019. And it turns out all 4 strategies actually had a profit in 2020. Now, it was a tough path for short volatility traders. Relative volatility did a nice grind higher, and both long volatility and tail hedge, which are similar strategies, but you can see that tail hedge is really set up to benefit from the volatility event. Although they're both down from March of 2020, they all four strategies had a profitable year in 2020. As I sit here and talk, I love when I'm talking and I have a thought of something I wished I worked on. I'm going to go back and see if there has been another year where all four strategies worked in the same year. My guess is going to be no, but you never know until you run the numbers. Just real quick on the short volatility strategies. Got a question: are speculators short volatility because of the contango of the futures curve, making a gain on the roll? Typically, I'm going to jump one slide and come back. Typically, they're short because of what we see here, where the futures are at a premium and gravitate down towards spot. That's typically, they're not necessarily playing the role, but they're taking positions where they expect, the futures, which are typically at a premium, expecting them to move down to the, work their way down to the spot index as we approach expiration. Now, looking at the term structure of the recent VIX indexes, this is partially a look forward, and this is where I get into the look forward part. Typically, when VIX is at an elevated level, like in the 20s, you don't see the longer dated volatility indexes at too much of a premium. But that is something that we have come into 2021 seeing. One opinion that I got, and again, when I say opinion, it means I've talked to a manager. One of the volatility managers felt like we're seeing the 3, 6, and 12 month at a premium relative to the 1 month, and of course this 1 month from last week. That they expect some sort of smooth sailing up until the inauguration next week, and then maybe as we start to find out exactly what kind of policies the new administration and the democratically controlled House and Senate might try to implement, there's uncertainty with respect to, is this going to be good or bad for the stock market? Not necessarily the economy, because there really has been a disconnect between the economy and the stock market. But looking later into 2021, the elevated levels that I see for these spot VIX indexes that focus on those different time periods, it really it makes me pause a bit and be somewhat cautious with respect to owning stocks and the possibility of some sort of sell-off going out into the future. And I showed the VIX curve already, but this flat shape from February to August, whenever we see a flat curve like this, it's indicating an awful lot of uncertainty. And because of the way that the futures are elevated at this time, at this time point that I grabbed, I would really think that we're seeing I worked with a hedge fund a long time ago, and the guy that was in charge of the company said, if you think there's going to be a sell-off, keep your powder dry. That phrase just popped in my mind. I think you want to keep your powder dry with respect to stocks through this year. Maybe you're going to get a better buying opportunity than where we are right now. So shifting over to technology stocks. Now, VolQ, the NASDAQ 100 Volatility Index, which actually has futures available on it now, is based on option pricing on the NDX or the NASDAQ 100. However, the calculation is slightly different. And the calculation uses closer to at-the-money option contracts as opposed to VIX and RVX and VStocks as well, which all three use a strip of options, which means that out-of-the-money put options, which can have an influence on those indexes as opposed to not having that sort of impact on VolQ. It's really, what are people thinking over the next 30 days for at-the-money options relative to a whole strip of options. And because of that, I kind of like it a little bit better. It seems to be more reactive as to what we're anticipating in the future for that market. You can see we've only got vol Q data going back to 2014. This past year was by far the highest average for volatility expectations on the NASDAQ 100 is measured by that index. Now, because it uses at-the-money option contracts, even though volatility for the NASDAQ 100 tends to be greater, at-the-money option volatility tends to be lower than out-of-the-money put options on broad-based indexes. So we often will have VIX at an elevated level relative to vol Q, except during periods where we're seeing really strong outperformance with respect to the NASDAQ 100. And we saw great outperformance for the NASDAQ 100 going into throughout 2020. And the big question is, what's going to happen with respect to 2021? And it appears right now, I know I just gave kind of a bearish outlook based on what's going on with VIX, but vol Q is really in line with VIX right now. And vol Q tends to have a seasonality that bumps it up at a premium when we approach earnings season, just because the NASDAQ 100 has 10 components, 8 of which report in the next couple of weeks. That will bump up the implied volatility of NASDAQ 100 options just due to the relationship between the option contracts on the individual names and the options on the NASDAQ 100. We're not seeing that going into this coming earnings season. And because of that, I have a feeling that there's an awful lot of bullishness, especially with the way that a lot of those stocks benefited from just the world environment in 2020. But there's a lot of bullishness on tech stocks, at least into the upcoming earnings season. And I honestly expected, as the world expects to come out of the pandemic and the way that we behave, not necessarily benefiting the big components of the NASDAQ 100 like it did back in 2020. I really expected more bearishness going into 2021 with respect to the NASDAQ 100 as indicated by vol Q, and I'm just not seeing it right now, which is surprising to me. If I visualized what I thought this chart would look like a month ago, I would have expected that blue line, which represents vol Q, to be at a really nice premium relative to VIX as we enter 2021. And just an environment that may not benefit tech stocks as much, but also an awful lot of uncertainty with respect to regulation and how it might impact tech stocks as well. Now, small cap stocks, there's a lot of bullishness as far as small cap stocks go from a lot of market pundits going into 2021. And the Russell 2000 Volatility Index is consistently higher than VIX. Sometimes it widens out an awful lot when there's concerns with respect to small caps, but it uses the exact same VIX methodology, so it's a better apples to apples comparison with respect to what are people thinking about small caps versus what are people thinking about large cap stocks going into this year. And RVX is telling a different story. Now, first off, we do have RVX going back to 2004, so we can get a comparison of Russell 2000 implied volatility. You can see that we actually did not make an all-time high on RVX like we did on VIX. In 2020, we had the widest range ever, and once again, the average was not greater than 2008, 2009, which I find somewhat interesting. I feel like maybe it's because it's more recent, but it seems like the uncertainty associated with the pandemic would be a little bit more worrisome than just a financial only issue that maybe we can work out. Now, RVX, you hear a lot of bullishness about small cap stocks. This is going to be a good year for them. They actually outperformed as we over the last couple of months of 2020, but at the same time, the implied volatility of options on the small cap benchmark on the Russell 2000 has remained elevated relative to VIX. And that, that makes me pause with respect to are small caps the place to be right now? Now you hear people saying it's the place to be, but at the same time, you've got people paying up for you're paying up for portfolio protection against a drop in small caps, and that just makes me wonder if derivative traders are not necessarily buying into the small cap bullishness that a lot of pundits are throwing out there. And maybe the pundits are throwing it out there because we just got a couple of months of small cap outperformance. But I would be I wouldn't be overly concerned with the Nasdaq 100 going into 2021. The S&P 500 and the Russell 2000, those markets are telling slightly different stories. So it's very possible, despite the strong outperformance of the Nasdaq 100 in 2020, if the derivatives markets are getting it right, that we're going to see a repeat of that in 2021, at least based on where the indexes are right now. Now, turning over to the European Volatility Index, VSTOXX, which I really do think gives us an awful lot of information, probably the best information with respect to risk perspectives in Europe. Now, VSTOXX had remained elevated for a good portion of the past year and was elevated going into about mid-December because it looked like we weren't going to get some sort of agreement around Brexit on the last day of 2020. Well, it does turn out that just before the holidays, they finally got an agreement. Did result in VSTOXX dropping somewhat, but it's still at elevated levels relative to where it's been historically. And we also do have a VSTOXX. Everybody likes to look at VVIX with respect to as a leading indicator for VIX. We do have a VSTOXX, which becomes very difficult to say over and over again, and it has remained extremely elevated throughout 2020. And I do think that the higher relative average for VSTOXX, when you compare it to VVIX, is a function of this Brexit overhang that did not turn out to be an end of the year problem that a lot of people were bracing for. I've got a VSTOXX versus VIX chart coming in just a second. So I just saw a question on that. And one of the great things about that Eurex does with respect to the VSTOXX methodology, they've got I showed the SIBO version where they've got 1, 3, 6, and 12 months. VSTOXX actually has 1, 3, 6, 9, 12, 18, and 24 month indexes, and they're reflecting the same sort of concern that I see in VIX, that there might be some concerns with respect to European stocks at least, and European stocks did not have the same year that the S&P 500 and U.S. stocks had. In fact, I think they were down slightly on the year, if I remember correctly. But the VSTOXX curve, very low on the last day of the year of 2020, and this is really a function that low blue dot is really a function of a drop that we saw as we got a lot of relief as Brexit seemed to work okay going into 2021. Although as we go out to 6, 12, 18, and 24 months, we've still got a very elevated VSTOXX levels. The curve was kind of funny. The far left part of the curve here, you can see that on the last day of the year, just because there was still a little bit of uncertainty with respect to how Brexit was going to play out with the final deadline at the end of the year. It played out fine. After the first week of 2021, spot VSTOXX dropped to a discount to the January future, and you can see that the January future was actually indicating that there was an expectation that the spot VSTOXX was going to come in a little bit. But the funny shape of the 1231 and the 18, the relative, how the big relative move is at the far left end. That really is a function of getting the VSTOXX at a V stocks at a lower level after getting that big known potential risk event out of the way. Typically, the long-term average for V stock has been greater than VIX. Sometimes it's a little bit difficult to look at a day-over-day comparison because things happen in the U.S. market after V stocks is closed. They do have the futures open a little bit later in the day. What I've actually been doing, and I don't have as long of a time period as I'd like right now, but what I've actually been doing is I have been taking where V stocks is and where VIX is at 10 a.m. Chicago time, which is basically about a half hour before where V stocks close, or the V stocks close on the day. And I just figured that's kind of a good time where both markets have been open and they overlap somewhat well, just because late day moves in VIX make the day over day comparison a little bit more difficult. And as I build out, there's a manual process to getting all those 10 a.m. numbers. As we finish building that out, I'm going to do a little bit more work. And when I come back to talk about V stocks in March, I'm definitely going to talk a little bit more about the side-by-side comparisons and what we found with respect to all of that. Now, just looking forward, that elevated RVX versus VIX, I mentioned I think there are some small cap concerns despite the outperformance. Vol Q, right now, NASDAQ volatility versus VIX, it's just not given a lot of hints. If anything, if I was forced to make a decision there, I would definitely say that the expectation is that stocks in the NASDAQ 100 are going to hold up better than the large cap S&P 500 and the small cap Russell 2000 stocks. That's my best guess for right now. And then both the VIX and V stocks complexes, they're showing some nervousness going into 2021 right now. I think if we see the whole curve drop and we fall into more of a contango type shape, that would be a good indication of the nervousness dissipating somewhat. And then things that are coming out, we are going to see, I shouldn't say gonna, I believe we will see options on Vol Q, which right now they do have futures on Vol Q. And the options on Vol Q should be out hopefully by mid-year, maybe into the third quarter of 2021. But I think that will help the overall liquidity of the complex for Vol Q futures. If you go back and you look at VIX futures volume, it was very lackluster until the VIX options launched, and then it just took off in line with the popularity of VIX options. So I think I know that the options should help with respect to the ability to take positions in Vol Q. They're in front of the SEC right now. I actually just submitted a comment in support of this, but there's an ETF that has been proposed. It's a -1 times short the VIX futures, and it's got a slightly different structure than the ETPs that we've seen in the past. It is in registration with the SEC. I think the comment period ends on January 22nd, that hopefully we'll hear something fairly soon. But I'm very hopeful that we're going to see approval in early 2021 and a way for people that want to, when we get the next big pop in volatility and you want to get short, hopefully there's going to be another way to go about getting short VIX futures, and also benefiting from the role that got brought up in an earlier question as well, because that fund will benefit from that, what they refer to as negative roll yield. I love that phrase. You're going to see more opportunities to trade the Russell 2000. There's going to be options that are going to trade 1/10 the size, and they'll be comparable in size with the IWM, but they will have a 60/40 tax treatment, which you get on index options, which for short-term traders that are not in a tax-free account is always a big benefit. Also, if you're in money at expiration, which does happen sometimes, if you're trading an index option, that I really like cash settlement with respect to index options when as opposed to suddenly having a long or short position in the underlying ETF. What I'm hoping for I'd love to see, every time I talk to my friends at my former employer over at SIBO, I'm like, please bring back the Russell 2000 Volatility Index futures. I really liked trading them relative to VIX futures. They offered similar opportunities to what you saw in the indexes as well. I would love it if we had a relaunch of a V-Stocks exchange traded product. I know the folks at Eurex would love that as well, but it would really be nice to be able to have a very streamlined way to go about getting long or short exposure to V-Stocks like we have for VIX right now. And in the past, a lot of people might scratch their heads when they see relaunch of commodity volatility futures. There were volatility index futures on both oil and gold, and didn't get a lot of interest. We did actually have the gold volatility index futures available when we got a 7 standard deviation move to the upside one day out of the price of gold, and that was a great opportunity to trade gold volatility. But I know that CME Group is looking, they've got their own methodology that they call the C-Vol, Charlie Vol. And I know that they're doing some work in this space. I wouldn't be surprised if we see some things out of CME Group as well. One thing I didn't put on my wish list, but I meant to, I'd love to see Russell 2000 options that expire on Mondays and Wednesdays. I've found a lot of success trading broad-based index options over the course of 1 or 2 days. Been doing a lot in the NASDAQ complex, and there's some videos available at Interactive Brokers that show what I've talked about in that space. But I've found Monday and Wednesday expirations offer a lot of opportunities. I'd love to see that for the Russell 2000, just because there's always elevated volatility for the Russell 2000 compared to the other broad-based indexes. So with that, I addressed every question that popped up while I was talking. I'll address any other questions that anybody else has. John, there's my email address. Send me an email, and I'll give you a little bit of clarification with respect to how I came up with the numbers that I came up with. I'll take a look at my Bloomberg and see if maybe there's an easy way to get what I was working on off of the Bloomberg, if there's an associate. I've just never used Bloomberg for CFTC numbers before. Whenever I'm put up a new article about trading strategies or whatever, I tweet it out. That's probably the best way for individuals to find out what we've been doing at EQDerivatives. And our website, EQDerivatives.com. Again, everything that I write about the markets, there's a lot behind a paywall, but everything that I put out there is actually in front of a paywall. So with that, Andrew, I'll bet you're lurking closely.
Thank you very much, Russell. Very entertaining and an informative session. If you have any questions for Russell, please put them into the question bank, because we're going to wrap up if we don't see any further questions. And of course, Russell's left up his contact information on the screen there. I was going to ask a question. Well, so the handouts from today's session are going to be on the GoToWebinar panel there for people to download in the PDF form. And if you want a link to the recording of today's session, which will be available in a couple of hours, please send me an email at webinars@interactivebrokers.com, and I will be happy to send it back to you. Otherwise, the content will be available for anytime download on the previously recorded webinars page. Education menu on the Interactive Brokers website. Go to webinars and look for the previously recorded. As I say, that'll be up by about 3 or 4 o'clock this afternoon. Looks like a question's come in, Russell.
Brian, that's a great question. Did the blow up of XIV affect the thinking of future ETF products? I'm gonna assume that you mean the thinking from the SEC kind of dragging their feet on approving a new one, and I think the answer there would be yes. But also, and I don't know the full. I would have to read all the documentation for the new product that has been proposed. But speaking to the individuals that are behind it, their feeling is running it as an ETF instead of an ETP. That and how the closing prices are going to be based a little bit differently than than the way that they were being done back in 2018. That with their short product, you will not see a repeat of the aftermarket activity that occurred because of XIV. So I think when you ask, has it affected the thinking? I think the approach to a short ETF has been improved based on that event for the people that are behind SDIX. But I also think that what happened back in 2008 has made the folks at the SEC a little bit more cautious with respect to approving something. So that's two different aspects of it. Let's see. Where can I get the description of the 4 volatility strategies? They're at different. Exchange sites. So if you shoot me an email, I will send you the link to the best sites to find out more about those four volatility indexes that I went through today. Are you talking about the 4 volatility strategies with respect to your Eureka hedge? Because if it's that one, I can send you there too. So there's 4 of those, and there were 4 indexes. So I'm not 100% sure. But as I read the question, either or, I'll send you to the right direction. Again, just send me an email and I'll send you to the right place. And let's see. I do put credit spreads on big ETFs like SPY and IWM. Which version of VIX that you showed would be best one to watch? For SPY, I would use VIX. For IWM, I would use RVX. And Diego, I feel like you've been on a webcast before where I've talked about converting those volatility indexes to 1 to 5-day moves, those sorts of things. So that's what I've generally done is I'll use VIX for an SPX or an SPY. I'll use RVX for IWM, and I use VolQ to help me choose the strikes for anything that I do in the NASDAQ 100 complex, and VStocks for anything that I do on the Eurostoxx 50. So the 30-day ones, but then converting them to a different day outlook based on the time frame of the how long it is until the options expire.
Very good, Russell. Thank you very much for joining us today. And I think you're going to come back in February. And what are you going to talk to us about in February?
What I want to talk about, I believe, looking at I know it's NASDAQ related, but I've forgotten I'm going to talk about strategies with NDX options.
Excellent.
I do know that. If you stall for 3 seconds, I can tell you exactly what it is. Oh, it's funny. It's actually using NASDAQ Volatility Index to trade the NASDAQ 100. It is basically an answer to Diego's question. That's the next one. So it's basically how to use those volatility indexes to choose strikes when you're doing credit spreads or iron condors as well, and iron butterflies. So Diego, come back in a month.
That would be a great place to leave it. That would be a great place to leave it today. Russell Rhodes of EQDerivatives, thanks so much for joining us and for educating the audience. And we will see you next time, everybody. Thanks, Russell.
You betcha. Thanks a lot, Andrew.
Thanks. Bye-bye now, everybody.
Bye-bye.